Hi everyone, welcome to YX Insights. This is Yimin. Today is November the 15th. We're recording a market update just before the market opens. So we are going to go through some of the key economic data that have been released this week, namely the CPI. And we're going to go through some of the macro themes as well as Bitcoin seasonality before moving on to some live charts of all the major names that we cover. All right, let's start. So October CPI came in a touch hotter than the previous month. So it was in line with expectations. But as you can see, the headline CPI accelerated from September, coming at 2.6% year on year. Core CPI is at 3.3% year on year, and that is the same level as the previous month. The concern now is that, as you can see from July onwards, core CPI has been stuck and actually it's been moving either sideways or upwards since July. And that's really not something the Fed wants to see. So the Fed has introduced the rate cut cycle. It's committed not to fall behind the curve, but at the same time, they don't really want inflation resurgence. And the worry is that the final mile of putting the inflation back to target will take much longer than expected. And that would be a really bad news if labor market softens at the same time. So just looking at the 3-month annualized rate, we see that the headline 3-month annualized rate has actually stayed flat, 2.4% on an annualized basis, which just means we're taking the past 3 months data and extrapolate for the whole year and how much does inflation come in. So 3.7% for core CPI on a 3-month annualized basis, a touch hotter than September, which we also expected. And finally, services also accelerated. So actually, back in July, it looked like services was almost falling into the deflationary territory, but now it has picked up. What's driven this? So just looking at the non-farm payrolls data, we saw the hourly earnings have come in pretty hot every time. And usually higher hourly earnings indicates higher labor costs. And if that's been passed on to the price of services, then you will see services inflation coming up as well. Just to break down the CPI report on a more granular level. So this chart is the breakdown of the month-on-month CPI items for the past 3 months. And I've highlighted the hot items with the background here. So you can see that the used cars and trucks prices rose by 2.7% month on month. That's a pretty big change, especially considering that they were in a falling trend before. And then secondly, the owner's equivalent rent of residence also came in higher than the previous month, 0.4% month on month. So this is quite high. And then finally, hospital services also rose. It was flat for 2 months, and in October, it rose by 0.5% month on month. So that's quite a big sudden increase. So overall, I think what we have seen is that hospital services, as we explained, the labor costs coming up. Used cars, a bit of a surprise here. It could be a seasonal thing. And the owner's rent has just been sticky since forever. That's not really been surprising. And the question really is, when is this really going to slow down significantly to help inflation getting back in line? And then in terms of the year-on-year changes, shelter, again, is the biggest component. And so what is the difference between rent of primary residences and the owner's equivalent rent? So the difference in the methodology is that the rent is literally what tenants would pay for the rent. But the owner's equivalent rent is essentially a questionnaire asking the house owners, if you were renting out your house today without the furnishing, etc., how much would you charge for your rent? And there has been a consistent upward bias between the two measures between the rent versus what the owners would want to charge. As you can see here in August, it was 5.4 versus 5, 5.2 versus 4.8 in September, and 5.2 versus 4.6 in October. So there's been a consistent upward bias for the owner's answers versus the actual rent that's been charged. But the owner's equivalent rent of residences actually play a huge role, a much bigger role in CPI, which I don't think is right, but that is the methodology, unfortunately, and that is what moves the market. I also want to point out that motor vehicle insurance has slowed down. So this, again, is a big part of overall headline inflation. Encouragingly, that is now moving down, and motor vehicle insurance is really a function of a lagging function of vehicle prices. So vehicle prices spiked during COVID and shortly after COVID, and now it has come down significantly. But the vehicle insurance has a lagging effect because new cars on the road, more new cars on the road, there's more accidents, probably poorer driving by new drivers, and all of that has pushed up inflation in this components, and also the supply chain bottlenecks back in COVID. So there's been a lagging effect in terms of the supply chain bottleneck and also the inflation components associated with that. And finally, airline fares also accelerated in October. And so again, this is not a big component, but it has a potential to become a headwind for the CPI. So these are the small things we're watching, as well as a big thing, which is the shelter component. And my observation is that since May, we've had essentially an intra-month pattern between non-farm payroll and CPI. So what we see is that the SPY at the top versus 10-year bond yield at the bottom is that SPY tends to bottom or rally after the non-farm payrolls. And you can see that in May, it's gone up. In June, gone up afterwards, same as July. In August, we had a crash the day after non-farm payrolls, but that was actually the bottom for August. In September, again, non-farm payrolls was actually the low of the month. October, it also started rising after the non-farm, and same story in November. And what we see in CPI is that CPI usually is in the middle of the rally. And I think it's to do with the timing of the print, which is always usually the mid-month. And the stock market tends to rise for a week after the CPI print. And you can see that in May, it didn't top until about 6 days after the CPI, again 5 days in June, 3 days in July, and then we had the August crash, and about a week in August after the CPI print, and probably 2 weeks after September print, because September print was quite early. In October, it topped about 5 days after the CPI, and here we are. We had the CPI print on Wednesday this week, and we had a dip on Thursday. But I don't think, just looking at these patterns, it doesn't feel like we have topped in the month already. And if the market continues to behave in the similar way that we've had in the past 6 months, we really should see SPY keep going higher, getting past the 600, which it touched a few sessions ago. And I think we will see in the technical analysis in the second, it should touch something like 615 before it tops out in the short term. And I just want to talk about the macro theme as well. So what we have is a dichotomy between the spot inflation expectation and the surging bond yields versus the forward inflation expectation and oil prices. And what you can see is that the red line is the 5-year spot to 5-year inflation expectation as observed by the break-even levels of inflation-adjusted bonds. And the spot to 5-year inflation and the 10-year bond yield have kept on rising since September, the FOMC. And I think that is really pricing in a Trump win and the potential inflationary effects of both the tax cuts as well as tariffs. However, the forward inflation expectation, which we use as the 5-year forward inflation measure, has actually fallen since mid-October with oil. So it seems that the oil prices are driving the forward inflation expectation much more strongly than the spot inflation. And the Fed is actually using the 5-year inflation measure as its guide for forward inflation. And so far, the Fed has ignored the 5-year inflation as well as the rising 10-year bond yield. So Powell during the FOMC said he's not particularly concerned. He feels the 10-year bond yield isn't that high compared to the year before, compared to last year, and the 5-year inflation has been benign essentially. So that's why the Fed is still willing to continue with the cut cycle, but with the caveat that they might not go too aggressively. If the labor market continues to hold up with unemployment rate staying roughly where it is today, I think the Fed could start thinking about skipping a meeting either in December or January, and they're not in a rush to cut too fast into the neutral level. And admittedly, the Fed says they don't really know what the neutral level is. It's something you have to feel your way around. When you get there, you know, type of thing. So currently, the market is pricing a quite high level of neutral rate, actually, and we'll see in a second. To me, it seems that a lot of the inflation expectation has been front run and pricing at this point. Looking at the FOMC table, so we're using the Fed funds futures to look at what the market prices in for each FOMC date, and therefore the probability of cuts. So between December and January, the market expects a larger probability of a 25 basis point cut, essentially in December, and then a smaller probability in January. So the market is really saying is that they think there's one cut between December and January, and they think that's likely to be in December. And after that, the Fed is going to skip a couple of meetings, cut again in July, and then skip again a couple of times, and then cut again in September. And the neutral rate is a 3.8. Do I think this neutral rate is too high? So this neutral rate was at 2.75 before the September FOMC when they cut 50 basis points. So now essentially this neutral rate prices away any chance of a recession. The market is really saying we don't think a recession is going to happen, and we're comfortable at this rate. And actually the bigger concern is the inflation for the next 5 years. Therefore, the Fed is likely to hold the neutral rate at a high point. But if recession does occur, I think this rate will drop rapidly, at least back towards the 2.75% that we saw before September, and potentially even further. So I do think the risk is asymmetrical right now. Can it get to 4%? Yes, maybe, but it's unlikely. Just 3 more 25 basis point cuts. That's what's pricing already. To just pricing 2 more or even 1 more versus having more cuts from this point, I think the risk is biased towards more cuts than what's priced in. So that does make me feel that the bond market potentially has bottomed, meaning yields has topped and bond prices have bottomed in the near term, at least. So I do expect to see a bounce in bonds. And finally, the last slide, we're looking at Bitcoin, which obviously has made huge headlines post-election, as it's just the market seems to be going up and up, and it makes new high every 24 hours, and there's a lot of FOMO now, FOMO money chasing the gains. What we see here is that if you look at the past history from 2016, which is when Coinbase started having the record for Bitcoin, we have essentially every time October and November both had positive returns, December also had strong upside momentum. And in fact, December tends to do just as well as November, if not better sometimes. So 2016, 2017, we had both green October, November, and December returned 30%, 29%, then 43% in 16, 17. In 2020, which is the election year again, we had 28% in October, 42% in November, and then 47% in December, which was even better than November. And then in last year, 2023, November didn't perform as well as October, but December still outperformed November. And 10% in a month, it's not bad at all for any assets. Finally, now coming into 2024, what I think is that we had October before elections, 12%, but even stronger November return so far. We will see some retrace, I think, but I don't think we're going to unwind all of the gains in November. So it's most likely, we still have 15 days, but I think most likely we're going to have an upside return in November again. So I do think December will put in another strong month. So what this is basically to summarize, I think the cycle is not finished yet, by far not finished yet. And we can see continued upside action in December. We might see a short-term retrace, but I think December will be a very good month. And where we can stop is potentially in January. So in terms of January's, it's much more hit and miss. When you had strong years, the Januaries don't tend to do as well as December. So SPY, I think we have stalled slightly after the election, but we had essentially a breakaway gap here. What I do think is going to happen is that we should continue to the upside between now and the next week, end of next week. And I do think SPY should be able to get above 610 at least. 620 would be a fantastic result, but I think 610 is very easily reachable. Once we get into this area, 610 to 620, we could expect a pullback. And a pullback would be very healthy for a December rally, I think, into the year end. So I would ignore the timeline scale on this because what I'm really marking is the price levels. But I do think we should be, there's no reason to think that the market has topped already. Just looking at the seasonality, the intra-month moves from the CPI, where we should see more upside in the next week or so. And QQQ roughly at the same place as SPY. I think we should get towards 525 before a retrace. And actually, maybe we can even push for 550 before a bigger pullback in the coming weeks. TLT. So my expectation is that we have bottom here. And you can say this is a double bottom, but it's still very early days in playing out this wave B. So wave B tends to be a three-wave structure, but it's quite early to see how this first wave lands. So what we should see is an A, B, C going up to complete wave B. But if we get a five-wave structure, then we could have even put in a medium-term bottom here. But my primary expectation is we should get a bounce, wave B bounce, but it's just too early to tell what extent and how it's going to play out right now. I want to talk about gold before we move on to the mega caps. The correction since end of October has been pretty rapid and is now dropping in a zone where I do think is quite near completion. And if you look at this, so wave A tends to be 3 waves. And if you look at where this wave A is landing now, the wave C of A is already at over the equal length of wave A and is approaching this 1.236 extension at 234. I think it could touch this VWAP. So this VWAP is from the June low. It could touch this VWAP and try to bounce before in a wave B fashion and before we get further downside in wave C. The reason I expect wave C downside, a bigger wave B than wave C down, is because I do think wave 4 should end around 223 level. But obviously, it's too early to tell right now. We need to see how wave B unfolds and then how wave C takes shape before we can really guess exactly where this wave 4 lands. But my expectation is that the low hasn't finished yet. We should see a short-term bounce and then short-term correction down to the 227 level, and then we can start targeting a wave 5 near 280. Silver, LSLV. So silver is at a similar place. It might even have run ahead of gold and finished its first leg of wave A. And while I think we could potentially bounce here to get a wave B as well, and before finishing wave C. And so the black line is a VWAP from August low, and the red line is a percentage offset. And we can see it's 3.25% from the VWAP, which has served as reliable support since the August low. The 3.25% is an arbitrary number that has shown support. So it's not like 3.25% working as any asset class. It's just within this context of silver in the short term, the market did its previous stop at 3.25% below the VWAP. And therefore, we're looking to use it as a supporting guide for a latest dip. So that's all it is. So nothing complicated here. What we want to see is a bounce, a 3-wave structure into wave B high, and then we finish lower in wave C to finish the wave 4 correction completely. It's too early to tell how far this wave B will bounce and wave C could unfold. As usual, we just have to take the price action step by step at this moment. Bitcoin, everyone's favorite asset for now, since the election. And very gladly, we've had trade subs from 57K. And actually, our initial target was 92K. I've not killed the live trade. I've kept it in only because I do think we can get higher. We can get over 100K now. So I'm just going to let that trade ride. But in the short term, I do expect some pullback. And how much? I think we've completed wave A, so the ABC wave of this wave A. And now we're into the wave C leg. So the wave B pullback of this wave C could really be anywhere between 76K and 82K. So 82K would be a quite shallow pullback. Again, we just need more evidence to see how it retraces first. 77K would be an excellent re-entry in my books if it gets there. Ether completed its wave 1 now. And we've had an ABC in this wave 1, and then also for the C leg, we had an ABC correction upwards. So I think that wave 1, we can conclude it's finished. Wave 2 typically ends between 0.618 retrace and 0.5. In a very strong market, it could be much shallower, like 0.382 retrace. in which case wave 3 will be higher, and we have a steeper wave 4 pullback instead. So at the moment, I'm just placing here 2.7K. There's not really much to go with at the moment in terms of the structure so far. But I think once it gets below 2.7K to just above 2.55K, then I think that's a good re-entry to target wave 3 level. I might even put in a short-term trade setup alongside the longer-term trade setups here as well. Coinbase has shown remarkable pattern since it bottomed. What I mean is that each leg up has been very similar in strength. And that has really helped us projecting into where it could land. What we see is that I think we have finished wave C high of this wave A leg at near 334. That was the high that was printed. And admittedly, that went much faster than I initially expected. Only at the beginning of November, everyone was super bearish. It was at the low end of this consolidation area. And now the price nearly doubled within just 10 days. So that was a pretty incredible climb. But now I think we're now getting to a wave B pullback. How far could wave B pullback go? Again, I think it's anywhere between 200 and 244. The thing about coin is that not every equity fund could buy things like IBIT ETF or underlying Bitcoin. So what they do is they use MicroStrategy and Coinbase as proxy to getting crypto exposure. And that's why you can see this chase had been so hot just within 10 days. So it is institutional investors trying to get crypto exposure and moving the price above its previous wave 3 high. I do think we have potential once the wave B completes a 50% pullback from this entire move, which will be 220. We can get all the way towards the 600 region in the next move. It sounds crazy, but given the lack of good exposure, good proxy trades for equity investors that don't have the mandate to touch Bitcoin ETFs or underlying coins, things like Coinbase, MicroStrategy, and Square to get bidded much higher than their fundamental value. And the final thing, I do think there is a quite strong potential we see 220 again, because in all of the up moves previously, the wave B had been about 50%, 0.5 retrace from the entire wave A. So that has been quite reliable historical signal. Obviously, every time is different, but it just makes me leaning more towards the 0.5 retrace versus 0.382 or 0.618. Now moving on to the mega caps. Apple, it's the price been consolidating. Essentially, it recovered a little bit from the Q3 result, and I think the issue with Apple is in terms of fundamentals. Investors really worry about China. Chinese iPhone sales haven't been that great in the past year. Why Apple has been so bullish despite Warren Buffett selling, despite slowing fundamentals, is because it has a really strong share repurchase plan. Every share Warren Buffett has sold has been bought back by Apple. And Apple still has a lot of firepower to keep the market going with the share repurchase plan. So I would not be bearish on Apple just because the fundamentals are not as strong versus the valuation. In the medium term, I do see Apple climbing towards 180. I think it can get there, and that wouldn't even be the long-term top. But right now, it's just consolidating in the past 2 quarters. I think it's built up a lot of volume here in terms of volume profile at this price point, and that will serve as a tailwind for the next leg higher. Tesla, we had a pretty strong run between the earnings, then election, and then post-election Trump trade, or Elon Musk trade, as it were. I think the tailwind is that now Elon is part of the government, and also for the Department of Government Efficiency, DOGE, and being the biggest supporter of Trump, Tesla should receive favorable treatment on the FSD regulatory side. I do think in terms of correction, we're nearly done with the correction. So we reached 1.38 to extension of wave 1 in this wave 3 of C. I think now anything below 300 is a pretty good time to get in, I think. If it gets get to this 284 level, or even 290, I think it's a very good re-entry to target the 400 level in wave 5 of C. So I'm just waiting to see if we can get slightly more downside from here. But between 284 and the current price, I think it's getting quite attractive to play that final leg up towards 400. Microsoft, again, similar to Apple, has been consolidating for the entire year, essentially. I do think there has been a lot of volume profile being built in this region between 400 and the current price. And that should help us really get the next leg up moving quite quickly. Once we take off from here and also above this VWAP now from the August low, we should be able to get to 480 quite quickly once it starts going. We can get a wave 2 pullback here and then heading towards a 580 as a wave 3 target. So overall, I'm bullish for Microsoft. Of course, until we clear this high, this all-time high of 468, we can never be sure that we're still in the bullish pattern. We can never be quite sure that we don't get a leg lower for like a wave C correction, as in wave A, B, C here. But overall, from how I feel how the valuation has adjusted downwards since this high, and how the price has consolidated all year with this volume being built up around here, I do think the next leg should be up and not down. And potentially that will help SPY and QQQ go higher in the next leg up. Amazon, I think Bezos has finished, or he's selling now for the year. And he's taken a lot of profit. And I don't blame him as a founder, with stock market rewarding him for 40% on the year, taking some chips off the table, doing his side projects, etc., whatever he wants to spend his money on. But price has seemingly stagnated. And all I think it is that we had wave 1 and wave 2, which is quite a big pullback, and the wave 3 and a small wave 4 here. And we should get to the 220 level for the wave 5 target. Over here, I'm not really incentivized to buy in terms of risk reward. I want to see a bigger pullback once this wave bracket 1 completes. Ideally, I want to see a wave 2 pullback, which could be 0.618 retrace of this entire wave 1, and I will target this 250 area. So I think any dip below 200, then targeting 250 is a pretty good trade setup for us. Google, we had an earning pop, and then before election it dipped because Trump and Vance had openly said they're against Google. They want to break Google up. They think Google, as a big tech, hasn't really served American interest. And also Google essentially had biased search results against Trump and Vance, especially the Joe Rogan podcast. There's regulatory concern around DOJ potentially trying to break up Google as well. That had been before the election. And if they were going to pursue it, Trump is definitely not going to stop it. And I think that those political regulatory concerns have held Google back. Google is pretty attractive attractively valued in terms of the valuation multiple versus growth. But I had been reluctant to set up a trade idea because of what I said about the regulatory concerns earlier. So for me to get a trade setup going, I want to see a pullback here, and I can use this wave 2 as a stop, and then we target the wave 3 at 270. I think that's pretty good risk reward, but it would just be a bit safer for us to enter with this stop here. Once it falls below the wave 2, what it could be is that this is a wave A from 1, 2 here. There's a wave A, and this is actually just a wave B wave rally, and we get a C wave down. And we want to just essentially get out of the way and let C wave to complete. Then we reassess when we get another the price building up to another 5 waves up for us to get bullish again. So for now, I'm not inclined to do anything with Google and just let the market decide what it wants to do. Meta, it rallied off this wave 4 low, and I do think this wave 4 low is in now, and we should be on our way to wave 5. A lot of volume building around the current levels, as you can see on the right here. And that always is a resistance if it's overhead and support when it's under. So, but right now we're right in the middle of it. We just need the price to really climb over and then take off. I just want to look at this wave 5 of 3 more closely. What we could have is something like potentially a further pullback, and we can have 5 waves up. To finish this wave 5 of 3. I think the upside is a bit thin now for me to put in a trade. So I really want to just see wave 3 complete, wave 4 pullback, and then we can play on the long side for this wave 5 above 730. NVIDIA earnings this week, we are right in the middle of wave 3 of 3. And I see the wave 3 resistance anywhere between 160 to 170 level around here. In terms of earnings, I don't really have so all of the mega caps, the Mag 7 stocks companies are spending a lot of money on chips, and they demand a lot of NVIDIA chips, especially the Blackwell. And I don't think that is a trend that will slow down anytime soon. All of the companies have said in 2025 they're actually going to increase the spending if not staying at the same level. So I do think NVIDIA stock has more room to run. I don't think it's finished. Going into this earning, I think it really depends on if we can get to this wave 3 resistance before the earning or not. If we are staying at this level because the investors don't want to do anything before the earnings, I think the earnings will propel the stock into this blue box, this zone of resistance, before falling back. But if we reach here already before earnings, which means the investor already pricing the positive sentiment for earnings, then we could get a direct retrace over here. So for me, the earnings event is less about really about the forward guidance or the capex expectation and the misses, etc. It's really about what's already been priced by the investor sentiment going into the meeting, going into the event, versus using the event as a turning point for the next leg up or down, given the technical levels. CRM, I think we've now topped at wave 3 of this wave 1. And I think I'm expecting a pullback towards below 300. And I'm just showing you what my expectations are. So we've had pretty strong run up, 1.764 extension of wave 1. I think we should correct to just above 290. Probably anywhere between 290 and 307, so around the 300 level. And then before we can target somewhere between 366 and 400. So I think we could get a set trade set up over here. Once it gets to around 300, we can target at least a 20% upside from there. But if you're even more patient, you can wait for this wave 5 to complete, wave 2 pullback, and we'll play a much bigger trade from essentially this, whatever this wave 2 pullback will be, versus the 600 target, which should be something like more than double. So I'm just patiently waiting for this structure to fill out, and then we can decide on the next move. ADBE, very good. We actually did bottom at 471, just above the VWAP. And then we cleared this VWAP from the September high, which again is bullish. It means both the short-term and the long-term stockholders are now in the money. So why have I not put in a trade setup yet? I think if you put in trade setup now, so if you do something like entering now and you target the 700 level with a stop below the C, pretty excellent, 3.5 to 1. And if you are you want to get in now, the risk reward is pretty good, to be honest. What I want to see is just fill out this 1, 2, 3, 4, 5 structure, 3 waves up, and then one A, B, C down, a wave 2 pullback. And then that just gives me the confidence of a bullish trend reversal from this downtrend of wave 2. And we can enter at the wave 2 pullback and then again play the same trade setup. That also just gives our capital a bit more efficiency as well. Instead of having to put in the money now, wait for this final wave up for wave 1, then pullback, that just saves a bit more time for us. So we get higher probability for the uptrend, as well as freeing up capital for other opportunities we see right now. Netflix. So this chart is different to what I showed before. Today, I spent quite a long time just removing everything from the drawing and then reassess what the chart should look like. And I do this periodically just to reset and make sure I'm not carrying on my previous assumptions, not having bias, and I should just look at the charts freshly to see what I was missing before potentially, and making sure that we are the analysis sound still. And I think what we are now, just having restudied the chart, I think we are actually in wave cycle 5 or the largest cycle 3. So cycle wave 3 is an extended cycle, it has a longer cycle, and we are putting in 1, 2, 3, 4, 4 finishing in the June 2022 low, essentially where Bill Ackman sold. And Bill Ackman sold because Netflix has changed its model to having ad-supported subscriptions too, and that was different to his thesis. But actually, Netflix has executed incredibly well and it's rebounded almost 6-fold since then. And I do think that did mark a wave 4 low when he sold, and now we're heading towards that wave 5, and we're right in the wave 3 of this wave 5. And the trend is pretty bullish. And just zooming on the daily chart, I think the day before the results was actually pretty excellent buy point, especially with 2020 hindsight. But what happened is that the earnings kicked off this wave 3 move that could go all the way to 960. The problem is that the risk reward for here is pretty much equal at the moment. So we don't really have a good point for support. So I'm probably just going to sit out this rally. And what we want to see get in is the wave 4 pullback, and we can play for the wave 5 of 3. So overall, I'm very bullish for Netflix. It doesn't seem to, it's an incredible business that has executed very well. We have a trade setup. It's basically stalled a little bit after the post-election jump, but it's still pretty good. I do think that we could potentially just move a trading stop at where we entered. So even in the trade, the price falls below where we bought, we can essentially stop out for free. So that's it for today. I think this week's market, because the broader market has essentially consolidated and digested a lot of the post-election moves, it's been proving a little bit tougher than last week, of course. But I will stay bullish in the short term. And I think my primary target is still for SPY, QQQ, and the mega caps to reach higher from here. So thank you for joining today. I hope it's been useful. Any questions, please ping me on Slack. And happy Friday. Thank you.